Welcome to the BK Crypto Weekly Roundup with your hosts Ansel and Kimberly.
Hey there.
Where we sip coffee and break down the biggest stories shaping the crypto world.
And what a week it has been, my friend.
Yeah.
It feels like the market went on a roller coaster that lost a few wheels. Grab your mugs, everyone, because we have a lot to unpack.
That's putting it mildly, Kim. Let's start with the big one.
Okay.
The event that had everybody's phones blowing up Friday afternoon, the flash crash.
Oof, flash crash, flash flood, flash fire, whatever you want to call it. It was brutal. For anyone who took a digital detox, Bitcoin plummeted.
Right.
We're talking a nosedive from around $117,000 down below $110,000 in the blink of an eye.
And that was just Bitcoin. The altcoins got absolutely, as one trader put it, eviscerated. Ethereum tanked 16%.
Wow.
Falling below $3,700. Solana and XRP were down, 20-30%? It was a sea of red.
And the trigger? More geopolitical drama. President Trump woke up and chose chaos, announcing a new 100% tariff on Chinese goods. The markets did not like that, not one bit.
It's a classic case of crypto's double-edged sword. On one hand, it's a global decentralized asset. On the other,
right,
it's still deeply sensitive to macroeconomic news, just like any other risk asset.
Yeah.
And when Wall Street sneezes, crypto catches a hurricane.
And oh, the liquidations. Over $7 billion in leveraged longs wiped out. For anyone new to this, imagine you borrowed money to bet the price would go up.
Okay.
But then it suddenly crashes. The exchange force sells your position to cover the loan.
Right.
That's a liquidation. And billions of dollars worth of them happened in a flash, pushing prices down even further. It's a painful, cascading effect.
It's the mother of all shakeouts. We saw a lot of leverage get washed out of the system.
Yeah.
It's a harsh but necessary reset sometimes. It reminds everyone that this is still a volatile space and risk management is king. But what's interesting, Kim, is how this ties into the other big story brewing in the background.
Which is?
The one happening in the halls of power in D.C.
Regulation. The tug of war that never ends. So while traders were in a panic,
Yep.
D.C. senators were busy throwing stones at each other over a massive crypto bill.
Precisely. Tensions boiled over this week. A proposal from Senate Democrats got leaked.
I saw that.
And it put DeFi, decentralized finance, squarely in the crosshairs. And they're suggesting a restricted list for DeFi protocols and strict KYC or know your customer requirements.
And the industry is not happy for good reason. The whole point of DeFi is its open, permissionless nature.
Right.
Forcing non-custodial wallets and protocols to collect user data, that's like asking the inventor of the internet to get a driver's license for every person who visits a website.
Wow.
It fundamentally misunderstands the technology.
One Republican aide called the proposal incoherent. A Democratic spokesperson shot back saying it's nonsensical to set a wedding date before the first date.
Okay.
Accusing the other side of refusing to negotiate in good faith. It's pure political theater.
But it has real-world consequences. The Blockchain Association said the proposal would, quote, effectively ban DeFi in the U.S. For anyone new, we're talking about pushing innovation, developers, and capital overseas. It's a high-stakes battle for the soul of Web3.
And it highlights the core conflict. Is crypto a tool for financial freedom and innovation?
Yeah.
Or is it a risk to be contained? Right now, Washington can't decide.
Nope.
And the market is caught in the middle.
So we have market chaos on one side, regulatory chaos on the other. It sounds like a terrible week for crypto, right?
You'd think.
But here's the thing. Zoom out a little.
Exactly. Zoom out. Before the crash, what was the narrative? October.
Right.
Bitcoin had set a new all-time high. Earlier in the week, the debasement trade is in full swing, with both gold and Bitcoin being seen as safe havens against inflation and soaring government debt.
And don't forget about the Ethereum ETFs. Since they launched this summer, we've seen steady institutional inflows. BlackRock and Fidelity are vacuuming up ETH. That's not tourist behavior.
No.
That's smart money building long-term positions.
Exactly.
It tells you that despite the short-term panic, the long-term conviction from big players is stronger than ever.
That's the real story of 2025. It's a year of contradictions. We have this brutal retail crushing volatility.
Yeah.
Driven by tweets and tariffs. And at the same time,
Right.
we have the slow, steady march of institutional adoption. The foundation is getting stronger, even if the house is shaking.
It's like two different worlds coexisting. The fast money traders getting liquidated,
Yep.
the slow money institutions accumulating. This week was just a perfect, if painful, snapshot of that reality.
Yep.
The culture is maturing, but it's not losing its wild side just yet.
Well said. The path to mainstream adoption is never a straight line.
Nope.
It's 2 steps forward, 1 violent, stomach-churning step back. This was that step back.
So what's the takeaway for the folks listening, right? Stay calm?
Stay calm and stay informed. Understand the difference between short-term noise and long-term signal. A flash crash is noise. An institutional ETF is a signal. A political spat is noise.
Right.
And a fundamental technological shift like DeFi is a signal.
I love that. Focus on the signal, not the noise.
And on that note, that's a wrap for this week's BK Crypto Weekly Roundup.
Yep.
We've had the crash, the congressional clashes, and the context to make sense of it all.
Now, here's a question we'd like you to think about.
Okay.
Does this kind of extreme volatility strengthen the crypto ecosystem by clearing out speculation? Or does it harm long-term adoption by scaring away newcomers?
Let that marinate. Stay curious, stay crypto, and we'll see you next time.